Welcome back, folks, to Investor Diaries. So, first things first, if you've not already done so, please smash the subscribe button right now to ensure that you always receive the latest content from Investor Diaries.
The Chinese stocks have enjoyed a robust recovery week since last week's massive capitulation. But do you, as an investor, invest in the ADRs of these Chinese stocks? What are the risks associated with these Chinese stocks? We'll discuss all about that in today's video.
So, we at Investor Diaries were motivated by signs of deeply oversold conditions coupled with extreme pessimism from the Wall Street. Then the State Council followed up with a massive stabilization move. It helped calm a lot of nerves during the capitulation.
And shortly after, Chinese President Xi Jinping emphasized the state authorities must minimize disruptions to Chinese economy despite the surge in COVID cases. That was the signal that we needed from the government. Notably, it didn't specify China will be moving away from its zero COVID policy.
So, given China's vaccination rates and massive 1.4 billion population, we should not expect it to happen soon. But it demonstrated that China is focused on stabilizing its economy and financial markets in 2022 as President Xi could potentially be seeking third term in the office.
Now, among the Chinese stocks, we firmly believe Alibaba, ticker symbol BABA, can be regarded as the bellwether. So the movements in BABA stock is a good indicator of the sentiment around Chinese stock. Now, for folks who do not know, Alibaba is the rough Chinese equivalent of Amazon.
So along with news on stabilization from Chinese authorities, Alibaba surprised us with a massive new $25 billion stock repurchase plan. The company even emphasized that it is the largest ever buyback undertaken by a Chinese internet stock.
So this certainly signifies that Alibaba believes the worst is over for the Chinese tech stocks. It's ready to deploy even more of its massive $78 billion of cash hold to purchase its stock on the cheap. Therefore, we believe that the investors should follow suit. In addition, we think the BABA stock is now significantly undervalued as the policy overhang now seems to be neutralized.
All right, so let's discuss why the 25 billion buyback is massive. Now, Alibaba has instituted two large stock repurchase programs since the stock's dramatic decline in late 2020. However, the current and the third program easily surpassed its previous $10 billion and $15 billion authorization as management went on offense.
That's right. Deputy CFO Toby Xu emphasized, quote, the upside share buyback underscores our confidence in Alibaba's long-term sustainable growth potential and value creation. Alibaba's new program runs through March 2024 and replaced the previous $15 billion authorization.
Furthermore, the company highlighted that it expended $9.2 billion of its last program on buybacks. Therefore, we believe that management wanted to communicate to investors that it was ready to go on the offense to crush the bears and help Alibaba turn a corner through 2022.
Now, let's discuss China's recent policy communication. China's State Council sent a clear intervening message to the market that it will actively introduce policies that will benefit the markets.
So several financial institutions like JP Morgan highlighted that Chinese stocks are uninvestable. It had undoubtedly triggered significant risk aversion amongst global institutional investors.
However, the world's largest asset manager, BlackRock, followed up with a note to clients highlighting that Hong Kong traded stocks have become extremely attractive after the recent declines. In a crisis, some valuations can reach levels previously not thought possible. Notably, the asset manager had slashed its holdings in Chinese stocks in 2021, such as JD.com. Therefore, a vote of confidence from BlackRock is undoubtedly in the right direction.
Further, Bloomberg reported that, and I quote, China's government said that it will step up policy support for the economy and capital markets. Now, this is the first clear indication that China was ready to introduce targeted monetary policy moves to shore up its demand side equation of the economy since its message last week.
And notably, China's State Council called for the adoption of monetary policy tools to sustain credit expansion at a stable pace. The authorities also promised to maintain policies that can support the economy and avoid measures that can hurt sentiment in the capital market.
In addition, China's government has also increased its cash surplus tremendously between January and February to levels last seen in the year 2000. Bloomberg reported that government deposits, which are listed under liabilities on the central bank's balance sheet, rose by a combined 1.17 trillion yuan, which is 184 billion US dollars in Jan-Feb.
That was the biggest increase for the 2-month period since comparable data going back to 2000. In addition, ANZ Group emphasized that it's a sign of the government getting ready to boost fiscal spending on infrastructure.
It added, there will be plenty of room for fiscal stimulus and fiscal spending will be significantly accelerated from March. Therefore, we at Investor Diaries believe that the signs are getting increasingly clear that China will facilitate the bottoming of its stocks by the second half of 2022.
Additionally, the zero COVID policy adjustment demonstrated some flexibility. China is not expected to reverse its zero COVID policy anytime soon, and it's justified. Given its massive 1.4 billion population, the potential overloading effect on its healthcare system could be unsustainable. Furthermore, we saw reports like these. As of March 14, 88% of China's population are fully vaccinated, but only 44.7% of the population received a booster shot for enhanced protection.
However, China introduced significant adjustments in its dynamic zero COVID policy recently. These adjustments shortened quarantine requirements and lowered the hospital discharge criteria. It also added antigen tests as part of its testing regime.
Therefore, state authorities are putting in place measures to cope with President Xi's verdict to minimize disruption to the economy and society. He emphasized strive to achieve the greatest prevention and control effect with the smallest cost and minimize the impact of the pandemic on economic and social development.
Consequently, Shenzhen was reported to have emerged from its lockdown despite surging COVID-19 cases in other parts of the country.
Now, what do we make of all of this at Investor Diary? China and its stocks are not for the faint-hearted. The 3 big stocks in China are Baba, JD, and Baidu. During the broad market sell-off, Baba was at one point trading at a PE ratio of less than 10, which offers great value and upside. However, the biggest risk with Chinese stocks still remains, that is regulation. All stocks will move violently based on the decisions and the communications made by the Chinese Communist Party.
So we think that Baba's massive repurchase authorization coupled with the Chinese government's recent moves are highly constructive for consumer discretionary spending from the second half of 2022. Subsequently, we also believe that the critical steps taken by the government in helping Alibaba and its Chinese tech peers will be beneficial over the longer duration of time.
For full disclosure, we at Investor Diaries have a position in Baba and Didi. We would believe that Baba is one of the safest option among the lot, and we would recommend a buy. Even value investors like Charlie Munger from Berkshire Hathaway are big proponents of Alibaba. On the other end of the spectrum, Didi is a super speculative stock and is only for one of the most aggressive investors.
And that's a wrap, folks. Let us know about your favorite Chinese stocks or if you've decided to stay away from them. Hope you enjoyed the content. We'll see you in the next one. Until next time, stay tuned and stay focused.
Thanks, everyone.